All right, so not all of these assets are listed at historical cost or even fair value. There's other mixed attributes within the balance sheet. One of them is current cost. Current cost represents what it would cost to purchase the same assets today. This one has a real limited play. It used to have a bit more, but some standards were changed. Right now, it only is involved in if a company chooses LIFO valuation and applies lower of cost or market to their inventory, which all inventory are required to be lower cost or market, but it's a very specific outcome in the whole judging what the market price really is for inventory. So very narrow scope. Current exit value, this is essentially fair value. So we've already covered that one with the fair value discussion. It was really called current exit value prior to 2008 when the fair value standard was implemented and codified, and that became the new buzzword for current exit value. Expected exit value, now these might seem the same, right? We're talking about exit values. And whenever there's something that's extremely similar, I really want you to dig into what is the distinction between them. Current exit value means that we have a market that we know we have a price for that we could sell it. Expected means there might not be a market, so we have to create an expectation. And as we know in life, our expectations rarely turn into reality. They might be close to reality sometimes, but there's going to be a deviation. So what we believe we will get in exchange for an asset in the future, and where this comes into play are any FIFO or average cost, and we apply LCM or lower of cost or market. Remember that term should be somewhat familiar. We'll cover it again in the balance sheet for sure. We'll talk about it again vis-a-vis conservatism, but that is a way that lower of cost or market is the order of the day in terms of valuing our inventory. And expected exit value is used to apply lower of cost or market in judging what the market price is for FIFO and average weighted cost. It also is used in receivable transaction. So our account receivable. Remember, we account our accounts receivable at the amount less our expectation of default able to pay. That is exit value. That's the value. That's a firm coming up with an estimate of defaults to subtract from the amount we're owed. The present value of expected cash flows is something that happens when we have financial instruments with interest. So you might remember some of this when you calculated time value of money, when you had a premium or a discount that you were applying to the face value of a bond or an investment, and because it had an interest rate that affected the present value of that instrument, and the present value was either it either sold for more than the face value or less than the face value. Well, that's the present value of expected cash flows. Well, you'll cover most of that in Intermediate 2. We'll talk about some of it with respect to notes receivable in this course. The next two principles are big. There's really only one principle that doesn't have far-reaching implications for anything you do in accounting. The revenue recognition principle tells us, and this is a direct pull from the standard, it tells us that companies should, quote, recognize revenue when goods or services are transferred to customers for the amount of money that is expected, that the company expects to be entitled to receive in exchange for those goods or services. Well, that seems to make sense, right? So when I sell someone an item, I should record a revenue only when I've sold it, given it to them, and then I expect to be entitled to receive money for what I just sold them. So I break it down into two pieces. The transfer of goods or services has to occur. So in order for us to recognize revenue, we have to meet these two criteria in order to recognize the revenue. And sometimes, that's a real simple exchange. It's what we call point of sale, where I directly deliver an item and they directly deliver payment. Then, revenue recognition becomes easy. But when you start breaking it across bundles of items that are sold together, like your cell phone with a service plan, with data, with updates, with potential warranties, then it becomes much more complicated. But let's return to the simple for a second. The transfer of goods or services. So the seller has to perform its side of the earnings obligation, right? So what is my obligation as the seller, as the company? Am I providing a service? How am I going to provide that service? Is it, I sit down and talk with them once and all of it is resolved then? Or is this a contract where they're going to be able to come back and, revisit and ask for more service over a period of time? But I have to have discharged at least some of that service in order to recognize revenue. The second part, so if we're really simplifying it down to one word, this is the earnings activity. Like, this is how I'm earning my money. It has to be earned. And the second one says the company expects to be entitled to receive. This is what we call the realization. Can I realize any payout from the earnings activity that I'm performing? So is the customer handing me cash? Well, that's extremely obvious that I'm realizing it as soon as I get that paper currency. Are they promising to pay me cash through a credit card? Well, again, because credit card transactions are guaranteed by the credit card company, right? Then I can record that as cash. Now, what if someone promises to pay me? Then it becomes a little harder, but still we have a certain amount of fair faith that we're going to receive that money from folks. We would say, all right, here's this product. I'm going to deliver it to you. You can pay me within a year's time. That would be an account receivable that we would record as the company, because while we haven't received cash, we have the expectation, we have to be entitled to receive that payment in the future. So we have to have both in order to recognize a revenue. When it comes to the matching principle is about recognizing expenses. Now, the first thing I really want to call your attention to is that these are two distinct items. One principle talks about revenues, one principle talks about expenses. I order them this way because we have to know, in order to recognize an expense under GAAP, we have to know what revenues that we recorded, because the matching principle's definition is conditioned on having revenues in order to match expenses to revenues. So what the matching principle says is expenses are recognized by matching, not matchings, matching them to revenues with which they are associated. So we look at all of the revenues we took in this year, and then we decide, well, what expenses did we incur, or what parts of the payouts that we made this year were associated with the revenues we recorded this year. So now you see the revenue has to be the antecedent. It has to come before we're able to determine what expenses to recognize. So the matching principle derives from the basic idea that businesses will pay cash and incur liabilities in their operating activities in order to create profit. And we want to match the outflow of assets that generated inflows of assets. Remember, we're not talking simply about cash here any longer. We're going to see this a little bit more when we get into defining these elements. What is the raw definition of an asset or of a liability? But for now, notice that I use a vague. I say the outflow of an asset or the inflow of a liability that generated an inflow of an asset or the settlement of a liability. We have different types of matching. The most obvious case of matching occurs when the revenue and the expense are just totally related, relatable on a dollar per dollar basis. The most obvious example of this is the cost of goods sold we recognize in an inventory transaction. So let's say that we paid $10 to acquire inventory in 20x1. So when we did that, we would record a debit to inventory for $10. We would record, we'll assume that we paid cash to make it easy. Maybe we got it on credit. It would be an account payable at that point, but we'll just say cash. So this is what we would have recorded in 20x1. Now in 20x2, we sell the inventory. Notice over here, we haven't recognized an expense. Yes, we have paid for inventory. However, we have not recognized an expense. And why haven't we recognized that expense? Because we have no revenue to tie that expense to. We have no revenue to match it to. But in 20x2, when we sell that inventory, then we would have something to tie it to. So let's say we sold it for $25 of cash. Well, then we'll record a debit to cash for $25. The credit would be to a revenue for $25. And this is an asset that's going up. This is net income. That the revenue is going to increase net income. Now, what else do we have to match? Now we pull in this $10 expense. We recognize the expense through an account called cost of goods sold for $10. That reduces my net income. It's an expense. And I credit my inventory because when I sold it, now I no longer have it. And so I reduce my assets by $10. Right? So the net effect of what happened in 20x2 is that I made gross profit of $15. I had a $25 revenue, but then I had cost of goods sold of $10. That gives me gross profit, or basically that net income went up by a pre-tax amount. It went up by $15. And I also had a net increase in my assets by $15. So this is how I want you, just a sort of preview as to like how I want journal entries to start to work for us in this course, where we track individual elements, assets, net income, and we have this sort of overall idea of netting things and understanding where we gained or lost over time. Now we go into indirect matching. Indirect matching is far more common than direct matching. It's when we know there's an association between the money we've paid and the money we're bringing in, our costs and our revenues, but it's still difficult to identify on a dollar spent to a dollar earned basis. Expenses incurred over time tend to fit here. So anything over time. And this applies to a lot of things like depreciation, salaries, pensions, interest, warranty, rent. All of those things go into an indirect matching bucket. When we think about depreciation, there is an example. I have an example set up on the next page. Thinking about depreciation, we pay $30,000 for a machine we are going to use for 3 years, and there's no estimated salvage at the end of its life. So that was at 12/31/X1 that we did that, and it's going to be 3 years that we're going to own this machine for. So when we pay for the machine, we debit machine asset. That's a PP&E asset, and it's for $30,000. Again, we'll assume that we paid cash by. And done here, exchange for another, and we're coming out netting nothing in this transaction. Movement to our abilities or equity, we've simply reclassified one type of an asset. Now, at the end of the next year, 12/31/X2, I've used this machine. Now, the idea, remember, of a useful life of 3 years means that we're going to use this machine to generate revenues for 3 years. So I don't want to recognize any expense here. Even though I've paid $30,000 in cash, the expense is saved to periods that we generate revenues from that expenditure. So we've generated revenues for a year. It's now been a whole year, X2, the first full year of the machine's life. Then we record depreciation expense and record accumulated depreciation. And we do it for 10,000 using a simple straight line procedure. That reduces net income. It also reduces my asset value. And then this would repeat every year for 3 years. 20x, 12, 31x3, another $10,000 goes out. And another, I said 20. Another $10,000 is logged into depreciation expense. And that was at 1231x3. Now, on 1231x4, this is the last year that I assumed the machine would be useful to me as a company. And the last year that I assumed I would be able to get any sort of earnings value out of it. Well, then have we fully recognized over the course of these years the amount of money we spent? Yes, we have. 10,000 here, 10,000 here, and 10,000 here adds up to the price of 30,000 that we originally paid for this machine. So depreciation is not about establishing an asset's market value or the wear and tear, right? That is a very layman's definition of what depreciation represents. It's not a decline in value. It's simply us matching to the revenues that we expect to generate from what we purchased, from the cost we incurred. The final item is when we have indirect matching and there's no definite period of time. So we either had direct where we could trace it, hey, I just sold something for 25. Well, when I sell it for 25, that's when I want to recognize the expense. Oh, I bought it for 10. We had that overtime where we could break it up into periods like depreciation. Oh, I'm going to generate revenues for 3 years. Let me match the cost for 3 years. Now we have this period that we have this sort of issue with a cost that there's little, if any, association between expenses and revenues that exists or that we're able to demonstrate. And these are in somewhat rare cases. But the most hallmark case of this and implementation of it is in research and development accounting. Now, this is something that I forgot, who knows exactly when the R&D standard came into being, but it certainly is now a large force in the American economy, given that we have a lot of tech companies, a lot of biotech companies, pharma companies, other software developers, patents being filed. Right, we have an explosion of these sort of intangible assets that need to have research and development in order to create the asset. Now, when it comes to this, really we're thinking on a timeline like, all right, well, in this case, we spent $1 million for developing a vaccine for COVID in 20X2. So what we would do then is just all $1 million would go right into an expense. We wouldn't bother even trying to match it. And we'll talk more about this toward the end of the course, what the implications for that are, and maybe some cases in which we can record small amounts of an asset, but it will rarely, if ever, be the total $1 million that we spent in R&D. And the reason is, well, yeah, we spent that in 20X2, but when is the benefit going to happen? So we had a $1 million cost, but where's the benefit? Is it going to happen right away? How long is testing going to take? Is it going to work? Maybe we've spun our wheels for 2 years and we still haven't come up with anything that's patentable. So is it going to be here? We're not sure. Is it going to be out here? Is it going to ever happen? And so because we don't know when the inflow of assets, when the benefit is going to arrive, we're not going to delay to recognize the cost in those future periods. We're just going to recognize it all in 20x2 when it's spent. And that is what we would refer to as a conservatism, or an instance of conservatism in accounting, where if we can't decide when to defer the expense, then we're just going to recognize it right now. All right. The full disclosure principle is not something that's all that interesting. It's the one of the four principles that I sort of push aside. It is important. One thing that I will point out real quickly that is important about it is that we should include all information to allow knowledgeable users to make informed decisions about the firm's financial condition. So we do not produce financial reports with the idea that someone with a high school degree should be able to figure out everything that's going on in an annual report. We don't produce it with even the idea of someone who has an advanced STEM degree. Engineers, believe it or not, die when they take accounting courses sometimes. Doctors die in accounting. I've seen it before. So they don't necessarily have a knowledge that translates into the business world. And therefore, we don't expect, even though that they're capable people who have achieved in other areas, we don't expect them to be able to unravel all the stuff that's going on here. We expect people to have a relative achievement within a very specific discipline, i.e. accounting, in order to understand what we're talking about. It would just be too cumbersome to think that we have to make the financial reporting world as transparent as traffic laws, which of course people screw up horrendously as is. So anything these days seems to be a cumbersome expectation of knowledge. Anyway, so that's the full disclosure principle. It does beget the use of a lot of footnotes to financial statements, and that's something that we're going to look into in this class. We're not just talking about the financial statements anymore. We also have to dig into the footnotes to the financial statements. All right, I'll pick up in the next video with constraints and head into the elements after a small discussion of constraints.